When a recession hits, panic sets in, but smart investors know it's not the end of the road. In this video, we break down what happens to your investments during a recession. You'll learn how different asset classes typically react, what strategies can protect your portfolio, and how to stay calm, focused, and even find opportunity in uncertain times. Today, we will talk about what happens to your investments during a recession. So before we get started, make sure to hit that like button, also subscribe to my channel. 1. Stock prices usually fall sharply during a recession. When a recession hits, stock markets often react with fear. Investors worry about falling profits, job losses, and slow growth. As a result, stock prices drop. Companies may make less money, and people may spend less. This creates panic in the market. Even solid companies can see their stock value go down simply because everyone is selling. The fall in prices can be fast and painful, but it's also important to know that this is a normal part of the economic cycle. Markets rise and fall. A recession is just one phase, and recovery always follows. 2. Bonds tend to perform differently depending on the type. During a recession, interest rates often drop because central banks try to stimulate the economy. When this happens, some types of bonds, especially government bonds, can become more valuable. Investors see them as safer than stocks, so demand increases. On the other hand, corporate bonds from weaker companies might lose value if investors fear those businesses could fail. In general, high-quality bonds become more attractive during recessions. They may not bring high returns, but they offer more stability and can help protect your portfolio during uncertain times. 3. Real estate may slow down but doesn't always crash. Housing markets can cool off during recessions. People might delay buying homes because of job worries or tighter lending rules. As a result, home prices may fall or grow more slowly. However, real estate doesn't always crash like stocks can. In fact, property values in good locations tend to hold up better. Rental income may also stay stable if people continue to rent. Real estate is usually less volatile than stocks, and while prices may dip, they often recover once the economy improves. It remains a long-term asset that can still build wealth over time. 4. Dividends from strong companies might continue, but cuts are common. Many investors count on dividends for steady income. During a recession, some companies cut or stop dividends to save money. This usually happens when profits fall or debt increases. However, companies with strong balance sheets may continue to pay dividends even in hard times. These firms are often in industries that are less affected by downturns, like utilities or consumer staples. It's important to invest in businesses that can survive a recession, not just those that offer high dividends. Quality matters more than yield when times get tough. 5. Your portfolio value may drop, but losses aren't real until you sell. One of the hardest parts of investing during a recession is seeing your portfolio lose value. But it's important to remember that these are just paper losses unless you sell. The market might be down, but history shows that it always recovers with time. If you sell during a panic, you lock in those losses permanently. But if you stay invested and patient, your investments will likely regain their value and continue to grow. Long-term investors understand that down markets are part of the journey. Staying calm is often the best strategy. 6. Emotional decisions can ruin years of progress. Recessions create fear. It's easy to panic when headlines are negative and account balances are shrinking. But reacting emotionally, like selling everything or switching strategies too quickly, can cause serious damage. People often sell low and buy back high, missing the recovery. The best investors stick to their plan, even when things look bad. They trust their strategy, know their goals, and avoid emotional moves. Making smart choices during a recession isn't about timing the market. It's about staying disciplined and thinking long-term. Emotion is the enemy of investing success. 7. Dollar cost averaging becomes even more powerful. If you regularly invest the same amount of money, known as dollar cost averaging, you actually benefit from lower prices during a recession. When stock prices drop, your fixed amount buys more shares. Over time, this lowers your average cost and boosts long-term gains. It also keeps you consistent, which is one of the most important habits in investing. Recessions can feel like the worst time to invest, but in reality, They often present the best buying opportunities. By continuing to invest through the downturn, you set yourself up for growth when the market recovers. 8. Safe assets like cash and savings accounts become more valuable. In a booming market, cash can seem boring. But during a recession, having cash can feel like a lifeline. It gives you flexibility. You don't have to sell investments at a loss if you have an emergency. You can also take advantage of new opportunities, like buying undervalued stocks. High-yield savings accounts and money market funds may offer better returns than usual during recessions, especially when interest rates are managed to fight inflation. While you don't want to hold too much cash forever, having some liquidity during a recession can reduce stress and improve your financial safety. 9. Recessions reveal the strength or weakness of your financial plan. When everything is going well, it's easy to feel confident in your investment strategy. But a recession is a real test. It shows whether your plan is strong enough to survive tough times. If you're overinvested in risky stocks or haven't set aside emergency savings, you'll feel the pressure. On the other hand, if you diversified properly, have a long-term focus, and are investing within your means, you'll feel more secure. A good financial plan includes protection for the bad times, not just the good ones. Recessions expose gaps that you can fix going forward. 10. Every recession eventually ends, and markets recover. No recession lasts forever. It may take months or even years, but recovery always comes. New jobs are created, businesses adapt, and spending increases again. The stock market usually rebounds before the economy does. Some of the best investment returns in history came just after the worst downturns. Staying invested, reinvesting dividends, and continuing regular contributions during recessions can lead to strong growth when the cycle turns around. What matters most is your long-term commitment. The economy will recover. Recessions are part of the economic cycle. They are difficult, stressful, and sometimes painful. But they are also temporary. What you do during a recession can have a bigger impact on your financial future than what you do during the good times. If you panic, sell your investments, or stop contributing, you may miss the recovery. But if you stay calm, follow a plan, and keep investing regularly, you'll likely come out stronger. Your investment performance during a recession depends more on your behavior than on the market itself. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.